So that's what I had been talking about, the variable cost. Variable cost per unit remains constant irrespective of the level of activity, and therefore it varies in direct relationship with the volume. Because as I increase my production volume, my cost that is connected with procurement of raw material, cost that is connected with engagement of laborers, all these would be increasing. There will be a change which is very much proportional to the volume of my production. That is a very basic nature of variable cost. But when we are talking about fixed cost, you imagine rent. In a normal case, there will not be any change in the rent we pay because of increase or decrease in the production, because of increase or decrease in the volume of production. Right. So that's why we say that when we are talking about marginal cost, it's an additional cost incurred for producing an additional unit of a particular product. So this is the basic first concept which you have to understand. Now going with the second one. This is the opposite, the other side of marginal costing technique. That is absorption costing. It's otherwise called as full costing or total costing. Okay, full costing or total cost. So the name itself says that when we are taking up a decision, it's not the concept of management by exemption. We take all the cost. We take into consideration the fixed cost as well as the variable cost when we go with a particular decision, which is just the opposite of marginal costing. Right? So the practice of charging all costs, both variable and fixed, to operations or process of products are called as absorption costing. These terminologies are very important from the theoretical angle for your university exam. So please try to learn all these very clearly, because these are simplest questions that can be asked for our university exam. So when we are talking about absorption costing, it is the other side of marginal costing. In marginal costing, we consider only the variable part while taking up the decision. But in case of absorption costing, we take both decision. So now the next thing is differential costing. We said that marginal costing can sometimes be called as incremental costing, or as we say decremental costing, because it takes into consideration the concept of increase in the cost or decrease in the cost. That's the logic in that. Okay, so differential costing is a method that takes decision based on the change in the cost. So it is more or less like what the concept what we discuss in marginal costing. So that is why it is interchangeably used in certain cases. If the change in the level of activity increases the cost, it is called as incremental cost. It's very easy to learn. Suppose, for example, I'm going to expand my production process of the company. Currently, I have been using only 50% of my production capacity. Now, I'm thinking of increasing my production capacity to 100%. So basically, the requirement of raw material would be high, the requirement of labor would be high, other indirect expenses would be high. Accordingly, it will lead to something called as incremental cost. Okay, there is another case, the opposite of it. Suppose if I'm planning to trade with the term called economies of scale. If I find that large production can help me in decreasing my cost, the cost of procurement of raw materials, the cost of transportation of raw materials to my factory, and the transportation of finished goods to outside the premises, all these can help me in reducing all these can help me in reducing my cost. Right. So in that case, we would be using the concept called as decremental cost. So we have, am I audible? Am I audible?
Yes, miss.
Yes. Okay, here there is the power failure. That's why I asked. Right. So we are talking about the concept of differential costing. When I say that, if I'm thinking about the cost that is that will be increased in my production process, that will be referred to as incremental cost. And when I'm trying to change or when I'm trying to decrease the cost, the concept is called as decremental cost. I quoted the example. When I'm trying to increase my production process, there can be increase in the cost of raw materials or the labor expenses, which will be referred under the category of incremental cost. When I'm trying to bring economies of scale in my operation, there can be a decrease in the cost with respect to procurement of raw material or my transportation expenses, all these warehouse expenses, all these, and which will be brought under the concept of decremental cost. So that is what we call as differential costing. Cost can increase or there can be a decrease in the cost because of a particular decision. So that's a concept of differential costing. Now moving further, this is something which we have learned from the beginning when we started learning cost accounting. But still, we have to be very thorough with the application of this equation when we are discussing about marginal cost. Okay, it's nothing but yesterday also we did similar one. Sales is equal to variable cost plus fixed cost plus profits. It's a primary equation, and we can also put that in a different way. Sales minus variable cost is equal to fixed cost plus profit. We really have to understand what is the logic here. Sales minus variable cost is nothing but contribution. We know that. Fixed cost plus profit, it's in the reverse way. From the bottom side, which is called fixed cost plus profit, which will give us, we will reach to contribution. Profit is equal to contribution minus fixed cost. This is it. All these have come from the primary definition of this. Sales is nothing but variable cost plus fixed cost. That is sales value. Okay, is equal to variable cost plus fixed cost plus profit. This is the primary definition of or primary equation of marginal cost, which we have to remember always while we are solving problems. Okay. And now I know that some of you have already familiar with the term break-even analysis, because in marketing we often discuss this. When we are talking about break-even analysis, it's nothing but it is the relationship between cost and profit when we are again relating that to the sales value. So we are establishing a relationship between cost and sales and thereby into profit, thereby analyzing the profit volume. Okay, so break-even point is a point where we do not have any profit, no loss. That means we have covered our cost fully. We have covered our fixed cost plus variable cost fully. If we cross the limit of break-even point, we start making profit. Once we are above, even if it is 1 unit above the break-even point, it will be very helpful for us in making profit, or it indicates that we have started making profit. So that's what we call as break-even point, where the total sales are equal to total cost. Right? It is actually an indication that a firm is okay, it is performing well, they may turn their business into a profitable mode. So that is why it is also called as an equilibrium point. Right now, the analysis of this, that is the cost, the volume, that is your sales, and your profit is together called as break-even analysis, because a firm will be able to understand whether we are in a right mode if we have reached at least up to the break-even point. Suppose if you are not in that position, the firm will have to improve its sales or reduce its cost in order to be in a comfortable mode. Otherwise, they will be making loss. Because if they have not reached the break-even point, it says that either the cost is too high or the sales volume is too low. So they will have to correct anything, maybe to increase the sales if it is possible, if they have demand for their products in the market, or they will have to try reducing the cost in order to turn their business into a profitable mode. Right? That's where we are talking about break-even analysis. Now, the next one which we are going to discuss is cost, volume, profit analysis. In a way, this is also studying the relationship between the cost of the product or cost of production, volume, sales, and profit. All these are using the same concept, and in order to analyze cost, volume, profit, we may use break-even analysis or a term called as margin of safety. Now, I'll tell you, the margin of safety is very easy to understand. It is actually the point after break-even point. It starts from the moment you cross your break-even point, you're set to be in margin of safety. That means your cost is covered. Now you have started making profit. Now, as the length of margin of profit or margin of safety increases, your business is in a profitable mode. I'll show all these in a grammatical way later in our class. I mean, in a graphical way later in our session. So cost, volume, profit analysis is we are analyzing whether the firm is able to cover its cost and make profit in this particular business. So that is what we call as CVP analysis or cost, volume, profit analysis. It is the techniques of studying the relationship between cost, volume of sales, and profit. Basically, in this context, we will be discussing two tools which are used to study that is break-even point and margin of safety. Right. Now, margin of safety is the difference between the actual sales and sales at break-even point. That's why I said, once you cross the break-even point, you are said to be falling into margin of safety. Right. So it is the difference between actual sales and break-even point. Amount of sales beyond the break-even point is what we call as margin of safety. It's actually a safety net for the firm. That's why the term has been coined margin of safety. Now, this is the graphical representation. This is actually the total cost line. You can see the fixed cost. It's very important. We really have to learn how do we prepare a graph based on figures. We will have to learn on how do we go with computation of break-even point or margin of safety using formula. Both these methods we need to learn. So now looking at this graph, we can find that the fixed cost is it is marked. And the combination of fixed cost and variable cost is here. This is this you can see. This you can see. And here, this is actually our sales line. It can start from 0 as it increases, right? This goes like this. And this marked area is the profit area, and this angle is what we call as angle of incidence. In fact, the point where the cost line intersects with the sales line, from there we will have angle of incidence. It is the point where our total cost line intersects with the sales line where we will have angle of incidence. And as the angle, as there is an increase in the angle of incidence, it is an indication of increase in profit. As this line bulges, as this angle bulges, it shows an increase in profit. Now, margin of safety, 5 is our break even. So we have marked 5, that is here it is 50,000 units. See, because x-axis 10,000 units 1 centimeter. So that's why it's 5 centimeters. So it is 50,000 units is our break-even point. Beyond 50,000 units, if we are able to make, if we are able to sell, then that will be our margin of safety. If I'm going to sell 55, yes, 5,000 is my margin of safety. If I'm able to sell 60,000, 10,000 is my margin of safety, because 50,000 is the break-even point, right? So this is what we were trying to discuss. So this is actually a graphical representation which is called as break-even chart. We will learn how to draw this also later in our class. So in these, using this graph, we can learn basically 4 terms. One is margin of safety, that is the point beyond break-even point. Break-even point is a point where there is no profit, no loss. Why? Because our sales line is intersecting with the total cost line. So it is covering this much is at least needed to cover the cost incurred by selling that. So it also talks about the sales volume required to cover the total cost. Okay, that's how it is being put. Now, the point, the second what we can learn from here is angle of incidence. It is the angle formed at the point where total sales line is intersecting with the total cost line. So we have learned what is margin of safety. We have learned what is break-even point. What is we have also learned what is actually the angle of incidence. Now, the particular nature of marginal costing is this, in a way, fixed cost line, in a way, it will happen. It will be there. So beyond this, what are the changes happening when there is a decision to increase production, when there is a decision to procure raw material from outside? All that will be taken care through what we call as marginal costing technique. Okay, that is basically the technique involved in looking into the changes happening in the variable cost due to a particular decision. That's what we do in the in the concept called marginal costing. So we have learned this. Now, this can be asked as an essay question, as well as there can be exercise associated with any of these decisions. So these are the basic types of decisions which will be based on marginal costing technique. Okay. One is fixation of selling price. As we know, selling price is basically, it will consider our cost, our volume we can sell in the market, and also our profit expectation. That's why we say that one decision that will be based on marginal costs is fixation of selling price. Then pricing in the period of recession. Say during recession, maybe for a firm is willing to sacrifice its profit margin because they know that they may not be able to sell the product at high price because the market is having a economic downturn. Right. So in that case, price is very sensitive. So they look into how well they can reduce, or what is the comfortable price which can be put for the product before it is being made available in the market during recession. Or how can they reduce the cost associated with production so that they can bring down their price, they can reduce their profit margin. That's the decision. Then giving offers, tenders, quotations. Of course, this is, you would like to know, suppose if I'm going to know tenders, or when I'm quoting something, I'm quoting that I will complete this work at this rate for you. So when I'm saying that, I should be very clear with the cost. What is the cost which I can incur? What will be the cost of raw materials? What is the cost of procuring other resources? All these I should know. So basically, I will be looking into the changes that is going to happen because of that particular decision. So I'm going to look into basically the variable cost. That's why we say that that is yet another decision that will be based on marginal costing technique. Make or buy decision. Suppose if I can procure a product at a lesser cost than if I plan to make it in my factory premises, it will be better for me to procure it. Right. The reason can be different. Maybe that product is raw material for my production process. Maybe that product, I'm acting as a wholesaler, and I'm planning to sell that to the other retail chains. That can be. But primarily, I will be looking into whether making it or buying it from a different market is cheaper. There also, I will look into the changes that is going to happen because of this particular decision. That's why we say that that is also based on marginal costing. Profit planning, yes, we said already, cost volume profit planning is one of the function of marginal costing. Acceptance of foreign orders. See, in certain cases, that's what happened in India with respect to Chinese products. Right. In certain cases, some products will be available from other markets at a cheaper rate. Instead of thinking of producing that in Indian market, we can procure it from a foreign market, provided when a company does that, they will look in from that perspective that this will not kill their existing market, because they already have a company which is selling the product, and if they have an option to sell similar product from a foreign market at a lesser price, they will be looking into many factors, like will it affect their present market, where their present regional market based on geographical classification, will it be affecting the other factors of production, or that can be decided only if we are considering the changes. That changes will always be incorporated in the variable cost. That's why we say that that is yet another decision that can be made, whether to procure it from a foreign market or to continue with the production within India itself, right? Say the best is when we are talking about outsourcing. Software companies, they will have this, whether to develop that in Indian market itself, or should they outsource it to a country, no, a foreign country for manufacturing. Normally the developed countries does that. US and all, they would be outsourcing part of their work to Indian software engineers, Indian companies, because it's much cheaper. That is based on this concept, how far the product by outsourcing some of it to another market. Can we reduce the cost? Can we develop the product at a lesser cost? All these decisions are trying to produce a new product. If I'm I'll tell you the example when ITC as a tobacco manufacturing company, they had a definite decision to channelize their business into different other ventures. Like, we know that they have gone into confectionery. Then some of your notebooks, classmate, that is actually from ITC. So basically they were a tobacco cigarette manufacturing company, but they ventured into different fields. At that point of time, they would have looked into what are the changes that is going to happen because of this particular decision. Definitely they will not be having much change in the fixed cost. Of course, they will have to develop a new factory, but the primary decision will come from how is it enabling them to earn more profit. That is really related with the variable changes that can happen. What is their sales volume expectation, and what can be their profit margin? Who are their competitors? What is the cost of raw materials? All these factors. So that is again a marginal costing decision. Then suitable product mix. What all products I should have in my product line. All that will be part of my select decision factor. Then the rest of the decision is like, if I want to evaluate my performance evaluation can be based on how much is my increase in sales, what is the reduction in my cost, right? What is the increase in my profit? All these are critical informations which are being provided by marginal costing techniques, right? So that again is another decision making area. Key factor or limiting factor is applicable when we have scarce resources. Sometimes I find that my raw material is very scarce, but I have n variety of products to be manufactured. But the raw material which I'm using for all these products, one of the raw material is very key, very scarce. In that case, I will have to look into the product which gives me higher contribution. I have to use my raw material for that product which gives me higher contribution. So that's a concept of marginal costing. Contribution is a concept of marginal costing. So that again is yet another decision of marginal costing. Then maintaining a desired level of profit, of course. Operate or shut down. That again is another decision based on my profit earning capacity. How far I'm able to continue with my profit margin or improve my profit margin in a present condition. Should I operate? Should I continue operate or shut down my business because in the present condition I'm not able to sell my product, or there is no market, or the market conditions are decreasing? See, you might have observed that in this pandemic condition, many of the shops have closed down. They've shut down. The reason is, it is actually because they have looked into the market, they have looked into the key factors like sales volume, total cost involved, and also the profit expectation. And if they find that that is not appealing to them, they would have ended up with the decision of shut down at least temporarily. So that again is very much related with cost volume profit analysis. That's why we say that it is part of marginal costing. And the last is planned merger, acquisitions, strategic decisions. All strategic decisions, of course, we will be looking into what is a change that is going to happen in my business? What is a change that is going to happen in my sales? What is a change that can happen in my total cost structure? That's why we say that strategic decisions are also, in a way, they will look into the fixed charges, but immediate decision will be based on the cost volume profit analysis or the impact of these strategic decisions on the cost, volume, and also on the profit of the company. So these are, along with that, there are many minor decisions which are part of wherever cost, volume, or profit is being analyzed. We say that it is part of marginal costing technique, right? So in our today's class, we learned about a few concepts which are associated with a technique called marginal costing. We said in marginal costing, the key word to be remembered is variable cost. Decisions are taken on the basis of changes that will happen in our variable component. That's why we discussed the concept of break-even analysis. That is, it is a point where there is no profit, no loss. That point is where a company is able to cover its total cost with its sales. Then we learned about margin of safety, right? It is point beyond break-even sales. And we also learned about angle of incidence and CVP analysis, cost volume profit analysis. And the decision, this is actually, if theory question is being asked, this is one essay that can be asked for a university question. Or we will do a lot of practical exercise connected with each of these decisions. So that again is exercise part. So with this, I stop here. And now if you have any doubt, you can quickly ask, or else I will share all these. You can read, bring that again back to our class on Monday when we are together in the physical class.